Life Sciences, symbol EW, as a possible long trade that has some attractive features. One reason is that the healthcare spider XLV is heading higher, and all of the biotech ETFs, XBI, IBB, are also heading higher. And Edwards EW seems like a real good choice to play some quick catch up here. We can see, just looking at the candle trader, that we had something close to a bullish harami yesterday, and a nice breakout, nice green breakout bar today above the 8 EMA trigger line and above the immediate resistance. We can see that it's clearing the 20 period EMA, or it's right at the 20 period EMA, and found support at the 50. So it may dance around a little bit tomorrow because it's playing with those moving averages, but if it goes through them and has a higher opening tomorrow morning, then we think there's a good shot that the run-up could start as soon as then. And looking at the daily chart, we can see that EW is at the bottom of the range. It made a print low about 97.20, which is almost right on the lower channel or the lower support line, and we expect to run up to at least the mid price, but more likely up to 110.90 or so over the next few weeks. But one reason that we found the chart attractive was that we did a Wyckoff tape reader view of the chart, and we had some interesting observations. Now, there's red numbers and black numbers here, and black bars and red bars, but you can see that the black bars, the close is higher than the open, and the red bars, the close is lower than the open. So if you're looking at a normal chart with colored bars, then usually the lower closes have negative volume attributed to them, and the black bars have positive volume, but that's not always really the case. And we're just going to zip to what happened toward the end here. And the high was made in April, and we've run down for close to a month. And we can see that this bar, with the distribution of a negative 807, a red 807, was the longest bar in the downtrend and had the highest distribution volume, which is exactly what you would expect. But let's look what happened the next 2 days. We had 2 additional down closes, including the print low at 97.20, but each of those bars was an accumulation bar. And following the accumulation bar at 97.20, the stock ran up. The bears tried to sell it down again, including a decent sized distribution bar with a negative 409 number, which was one of the highest distribution numbers since the high. But the point is, the bears were unable to bring the price down below the print low. So it's as if the buyers were holding open a bag and saying, throw in whatever you got, we're going to take it all at these prices, which is apparently what they did. And the last bar, which is today's bar, Thursday's, we had a 570 accumulation on a decent sized bar. So with Wyckoff and volume spread analysis, it appears that Edwards is under accumulation right now. But let's go back to our market location chart. We're probably going to do an option trade, so we open the CBOE option chain for Edwards. And the first thing we do, as always, is we looked at the call open interest, or sorted on it, just to examine which strikes and which expiration cycles appear to have the most activity. And we can see 78 appearing in several different places. So we like to go a little longer than 45 for a debit trade where we buy premium, and 78 is the regular August 19th expiration. So that would be the strikes, or that would be the expiration cycle we'd be looking at. And we're just going to do a quick strategy preview here. We're looking to buy, let me see, we want to scroll up here a tad. Let's go to days 2. Okay. We'll go to 78, days 2, the August 19th expiration cycle. And when we do a debit spread, we buy one call in the money and sell one out of the money. So the stock is 102. Let's drag and drop that into there. So we'll use the 105 as the call would buy, and the mid price is about 670. And let's say we'd sell the 105. Make it simple. And the mid price is about 430. It's a debit spread. So we can see that this particular spread, buying the August 19th 100 call and selling the August 19th 105 call, would cost about $240, has about a 50-50 shot of succeeding or making a penny at least. And the max gain we can make is $260, but the break even is $102.40, which is only 30 cents above the current price. So Edwards, which we think is a mover, but even if it went up a little bit, came down a little bit, went up a little bit, and didn't make any significant advances, that we're not likely to lose on this trade, just based on the statistical evidence. Now you can examine different strikes. We could look at the 110 strike as the buying strike, keeping the 100. And that'll give us different numbers. That'd cost us 413. The probability of profit would drop to 43, but maybe more importantly, the break even would jump up to 104.13, which is 2 points from the current price. So it's a few $100 more potential profit, but a higher risk and a lower probability. But those are the kinds of calls that you have to make. You might want to look at a 95-105, a 95-110. There's all kinds of possibilities. But one nice little feature of the strategy preview chart is the 1 month standard deviation for movement in EW based on current volatility is about 7 points. So the 5-point call spread would likely be exceeded. The 10-point call spread would not. So the 100-105 is not a bad choice. But there's one other thing you can do to really juice it up and make this trade interesting. We felt pretty confident that 97.20 low was likely to hold. And here's something that we can do. The mid price of the 95 put, same expiration cycle, is 288. If we sold that put, would bring in $288 in credit against the $240 we paid for the call spread. So in effect, we'd be being paid almost $50 to make that trade. And if you're half confident in Edwards' future, that's not a bad trade to consider. But I think we're going to be looking at Edwards Life Sciences at the open in the morning and making a decision probably between 9:30 and 10 o'clock.